Gold soars, banks shiver, repo market signals trouble. The world's financial system just sent out another alarm bell. On October 17th, 2025, gold smashed through $4,300 an ounce. Global equities slumped, and deep in the shadows of Wall Street, the repo market. The plumbing of global finance is flashing warning signs. For the average investor, this might sound like another day of market noise. But what's unfolding now has echoes of 2008 and 2020. Gold is on a parabolic run, banks are wobbling, and the system that underpins daily liquidity, the ability of banks and hedge funds to borrow overnight, is tightening. Today we'll break down why gold is surging and what it really means, why equities, especially banks, are in freefall, why the repo market, something you never hear about on TV, is the single most important chart right now, and finally, what all this means for regular people. Your savings, your mortgage, your job, and your pension. Gold, safe haven on fire. Gold just had its biggest weekly surge since 2008, topping $4,378 per ounce before cooling slightly. Why is this happening? Central banks have been buyers for months, diversifying away from dollars. ETF inflows show retail and institutional investors piling in. Macro fear, geopolitical risks, slowing global growth, and distrust in banks. Technical triggers. Once gold broke through round numbers $4,000, then $4,200 momentum funds kicked in, pushing prices even higher. For context, in 2008, during the financial crisis, gold surged because investors no longer trusted bank collateral. The same psychology is at play today. Gold is being treated not just as a commodity, but as an alternative collateral, a replacement for cash or treasuries when trust is shaky. What this means for investors, gold is now more than a hedge. It's a barometer of liquidity stress. When gold goes parabolic while equities fall, it usually signals deep fragility in the system. Equities, banks lead the sell-off. On the stock side, it's a different picture. The FTSE 100 fell to a 2-week low, dragged down by banks and oil majors. The stocks 600 also dropped as U.S. banking stress spilled into Europe. Bank stocks are the weakest link. Their funding costs are rising at the very moment loan defaults are creeping up. Meanwhile, energy stocks are under pressure as oil prices slide. Defensive sectors, healthcare, staples, utilities, are outperforming, showing classic risk-off behavior. Tech is showing selective resilience, cushioned by falling bond yields, but the rally is narrow and fragile. This isn't just sentiment, it's mechanical. When liquidity gets tight, leveraged players, hedge funds and banks, are forced to sell equities first. That's why bank stocks often lead downturns. They're both the cause and the casualty of funding stress. The repo market, the plumbing of finance. Here's the part most people miss. The repo market is where banks and hedge funds borrow cash overnight using treasuries as collateral. It's supposed to be boring, but when repo rates rise, it means something is breaking. This week, short-term repo rates ticked higher. Collateral is tightening. Liquidity is drying up. History shows what happens when repo spikes. In September 2019, repo rates suddenly shot up, forcing the Fed to intervene. In March 2020, during the COVID crash, repo stress added to the panic. Today's moves aren't yet at crisis levels, but they're enough to put traders on edge. Because if repo keeps tightening, it forces leveraged investors to unwind positions. That means equities go down while gold, the one thing you don't need a counterparty for, goes up. Why it's happening? 1. Credit jitters. Regional banks still carry exposure to shaky loans, and big institutions are nervous about counterparty risk. 2. Policy expectations. Markets now expect the Fed to cut, which lowers real yields and makes gold more attractive. 3. Repo stress. Rising repo rates equals higher funding costs. For hedge funds and dealers, that means deleveraging. Equities get sold first. 4. Momentum. Gold has crossed technical lines and momentum funds are chasing the breakout. Gold versus repo, the critical link. When repo stress rises, cash becomes scarce. Banks and funds start hoarding dollars. In that environment, gold suddenly looks like a safer, more reliable store of value. The irony? If repo stress becomes systemic, gold can spike even higher in the short term, but eventually, even gold can get sold. Not because it lost value, but because investors are forced to raise cash. That's what happened in March 2020. Gold dipped briefly before soaring to new highs. What does it mean for regular people? Most people don't follow repo markets or gold charts. But here's how this trickles down. Mortgages and loans. If banks face funding stress, they pass on higher costs. Repo tightening today could mean higher mortgage rates tomorrow, even if central banks cut policy rates. Savings. If the system wobbles, expect more bank bail-ins, hidden fees, or restrictions on withdrawals. The stress isn't just on Wall Street. It filters into Main Street. Jobs. When liquidity dries up, businesses can't roll credit lines. That means layoffs, hiring freezes, and weaker growth. Pensions. Equities under stress hit pension funds directly. If banks slide and markets fall, pension portfolios take the hit. Everyday prices. Gold surge signals distrust in fiat money. That often comes hand in hand with inflationary pressure, meaning food and energy costs can rise even as wages stagnate. In other words, repo stress may sound like trader jargon, but it directly impacts how much credit is available in the real economy. It's the hidden wiring behind your job, your mortgage, and your retirement account. Checklist for next week. What should we watch next? Repo rates, especially the spread between overnight repo and SOFR. Bank headlines, regional banks in the U.S. and credit headlines in Europe. Central bank language. Look for the Fed and ECB to hint at emergency liquidity facilities. Dollar trajectory. The dollar is still the world's funding currency. Its weakness is helping gold. Bottom line, gold surge isn't just about fear, it's about funding stress. Banks are the weak link and equities are pricing that in. The repo market is the canary in the coal mine. When liquidity tightens at the plumbing level, the entire market structure shifts. For investors, this means prepare for volatility. For regular people, it means expect higher borrowing costs, shakier pensions, and more economic uncertainty. The lesson: watch gold, watch banks, but most of all, watch the repo market. Because when the pipes clog in the financial system, the whole house shakes. If you found this video valuable, hit that like button, subscribe for more financial freedom strategies, and share this with a friend who needs to see it. Because the future isn't coming. It's already here. This is Felix. See you next time.